Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone, and welcome to Coasting in Retirement. I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Happy New Year, Michelle. How you doing?
Happy New Year, Josh. Doing well. Woke up with tornadoes, and now it's sunny and warm outside.
That sounds like January in lower Alabama for sure.
For reals.
Well, hey, folks, we got a great show for you today to kick off 2023. First, for those of you new to the show, I'm Josh Knoll. I'm the owner of Gulf Coast Financial Advisors, an independent financial planning firm located in downtown Fairhope, Alabama. We serve clients up and down the Gulf Coast. You can learn a little bit more about us at gulfcoastfa.com. We'll repeat that later in the show. Michelle and I are here today to discuss various financial topics relevant to those in or near retirement, living their best life here along our part of the Gulf Coast. So, Michelle, you and I started off our new year with what you call intentions, not resolutions, but intentions. So can you describe what that means for the listeners?
Okay, so intentions are usually the process of getting to a certain point, whereas resolutions is the end game, and they usually disappoint you because you ruin it by the end of the week, the first week of the year. So intentions are about the process to get to where you want to be.
Well, I'm going to use your definition. Intentions are courses of action versus resolutions that are more of a determination. Resolutions equal outcome, intentions equal process. So I like that. And that got me thinking. A show based on financial resolutions, which is all the shows are out there right now, that'd be too easy, right? Right.
And disappointing. You disappoint yourself.
Well, resolutions, save more, spend less, buy generic.
Lose weight.
We must try harder, right, Michelle? So what we're going to do is we're going to dig a little deeper by making intentions not only the main topic of today's episode, but we're going to give it the space to breathe with a two-part mini-series episode that's going to be very epic. So this is part one. And honestly, listeners, to be honest with you all, my list got too long for one episode. So this week and the next week, we're going to discuss what parts of the financial planning process that those in or near retirement should focus on as we enter 2023, not 2022, as Michelle had to correct me earlier today. What should be the financial intentions of pre-retirees and retirees in 2023? You ask? Well, we shall answer. And because I'm a huge nerd and I like to number everything, and I keep a never-ending to-do list always by my side, we're going to title our mini-series The Top 7 Financial Intentions that Every Retiree and Pre-Retiree Should Have for 2023. So what we're going to do, we're going to break it into two parts. Today we'll start with the first four. Everybody ready? Here we go. So here are the 2023 financial intentions we're going to cover today. There's no particular order. Number one, reorganize your financial plan to help deal with sequence of return risk. We'll come back to that. Number two, take a hard look at your Social Security and, if possible, delay turning on your benefits. Number three, investigate how a high interest rate environment can actually be your ally when it comes to income production and retirement. And number four, again, no particular order, take action to accommodate inflation in your retirement plan, including an honest assessment of how much inflation is affecting your daily life versus your investment accounts. So, folks, even breaking that down, that list into two parts, there's still a lot to digest. So let's go one at a time. First, sequence of return risk. What is it? Here's a simple version. Many folks that will retire, especially nowadays, will be in retirement for 20, 30, maybe even 40 plus years. At some point during that amount of time, there will be at least one bear market where the market is down over a period of time, probably more than one over that much time. Your finances will be much worse off if that slump occurs at the outset of your retirement versus the middle or the end. Think of the folks that retired in 2008. The example will make more sense here in a minute. It's kind of the mirror reflection of how everybody tells you when's the best time to start investing, 20 years ago or today. And really the best time to start is early as you can. That way your cash has more time to benefit from compounding returns. And so what happens on the mirror side of that is when you take money out of your investment accounts in a bear market, you're going the opposite of that direction. You're decimating your principal and you're permanently reducing the basis for enjoying the benefits of compound growth. Here's a good math example. My mom was a math teacher. Let's say two retirees start out with $1 million in their retirement portfolio. Each of them withdraws about $50,000 per year for expenses. That'd be a 5% withdrawal rate. Investor A is hit by a 15% market decline in the first year of retirement. As a result, runs out of cash by year 18 of retirement. That's not good. Investor B, again, with the same $1 million, same $50,000 withdrawal, he's hit by a 15% market decline in year 10 of retirement, but mathematically, he will still have $400,000 left at the year 18 of retirement. Now, we'll have on our website a chart that shows you how that works. That sounds pretty dire, and mathematically, that is accurate. That is how it goes. It's all about sequence of return risk. So how do you mitigate this? It takes having a plan. It takes having other investment buckets and asset classes that you can dip into instead of selling your positions at a low point. And really, at the end of the day, what you're trying to do is minimize principal withdrawals during a market downturn early in retirement. It's part of the function of making sure you don't outlive your money, as you saw in the example earlier. And one of those things that we really try to focus on when we're doing our financial plan, sequence of return risk. All right, next up, Social Security. Anyone that has looked at their Social Security projection statement knows that the benefit tends to get higher every year that you delay taking Social Security. If you're like Michelle, you're hoping that it's still around during that time period, right?
I have dire expectations.
Well,
but I will reiterate that Social Security benefits went up this year.
They did. Had a cost.
Almost
yes.
$140 a month starting now.
That's right. Cost of living increase, which we'll talk about here in a little bit. What most folks don't know, that once you reach full retirement age, which it typically is between age 65 and 67, that's determined by the government, you will get an extra 2/3 of 1% for every month that you delay after your birthday month, which adds up to 8% to each full year you wait if you can hold off taking Social Security until age 70. So in my opinion, and I gotta say this very carefully, and I mean this is only my opinion, it's really the only investment where you can kind of sort of squint at it sideways and say that it gives you a guaranteed 8% return over that brief time period. Now, it's not that simple. Nothing in investing is guaranteed. But when you add in the fact that Social Security also has to accommodate for cost of living adjustments, what Michelle just referred to, there's typically a tipping point to where the additional benefits from waiting mathematically will outweigh the payments received from starting Social Security early. Now, there's ways to use some programs and some process, sometimes involves insurance to help offset the loss of early benefits, but really that's a larger one-on-one discussion. One way or another, if you're someone that is eligible for Social Security this year or coming up on it, please give us a call or at least another qualified professional to discuss your options. You can always call us at 251-333-5151. All right, third on our list of financial intentions, not resolutions, involves how a higher interest rate environment can actually help with your production of income in retirement. So most investors have already seen the effect of rising interest rates that they've had on their fixed investments. If you've checked bank CD rates here recently, you've seen that they are offering higher rates of return than they have in many years. More specifically, many investors will often use annuity products to produce income in retirement. Now, I'm not going to go into all the different kinds of annuities again. We don't have time for that. If you want to learn more about that, you can find our Coasting in Retirement podcast on Spotify or Apple or anywhere you get your podcasts. Go to episode 3. We break down annuities in depth. But let's briefly talk about income annuities here. Insurance companies do not directly base their annuity income payouts on the Fed fund rates because that's a short-term rate. And insurance companies tend to look longer term with their payouts. But broadly speaking, bonds, which are influenced by these rates, are a significant part of any insurance company's annuity portfolio. It's what they use to determine the payout on their products. When interest rates rise, insurers get a higher yield on their bonds, on the new bonds, which generally they pass along to consumers in the form of a larger monthly check. So all that is to say that rising interest rates, while it kind of sucks for those getting mortgages and car loans and things like that, can actually help those in retirement generate a higher payout. All right, lastly, we talk about taking action to accommodate inflation in your retirement plan. It's something we touch on a lot. What does this mean? Often a pre-retiree or retiree will be tired of the ups and downs that is just inherent with having equities in their portfolio. And what I mean by equities is it's the individual stocks, maybe mutual funds, maybe ETFs, that they tend to go noticeably up or down with the stock market, particularly when there's a lot of volatility, Michelle's favorite word that we've had over the last couple of years.
Very hard to say.
Yeah, it's very hard to say, especially having an overbite like me. But for good reason. You know, the folks have worked really hard for their money for many years and for that bucket of money, and more often than not, they just want to protect it. So, you know, the joke of let's bury it in the backyard or let's put it under the mattress, if you will, The problem with doing that, specifically with your cash or just leaving it parked in a checking account or a low interest drawing savings account, is that it's constantly losing value in the form of inflation. And especially during high times or high inflation like we've had recently, it's losing its purchasing power very quickly. So over the modern history of our economy, one of the only proven ways to combat inflation is by owning equities. Again, pieces of ownership in a publicly traded company typically. How do we accommodate both sides of those desires in a financial plan, to preserve capital but not totally lose the inflation battle? It often involves holding equities, but holding them in a methodical and planned out manner as part of a comprehensive financial plan so that you're not just going to bed upset because you saw something go down when you weren't expecting it. What does this comprehensive financial plan look like? There's too many details and options to fully discuss in this episode, but let me give you our basic process at Gulf Coast Financial Advisors. First, we figure out how much you'll need for the retirement you've been dreaming about, not the retirement that you settle for. Next, we uncover the main risks posing a threat to your retirement, including inflation, stock market volatility, potential tax increases, skyrocketing healthcare costs, etc. Then we discuss options for generating income in retirement and putting your investment portfolio to work doing specific jobs such as battling inflation, as we just talked about. And finally, we discuss how to keep your current standard of living in retirement even as costs keep rising. Now, these strategies are designed in part to help you with inflation and longevity risks. Longevity risks is a fancy way of saying you don't want to outlive your money. Not only are we trying to match your risk tolerance to your investment holdings, we also want to make sure you don't end up outliving your money. If you're interested in having this conversation, just give us a call at 251-333-5151 or find us at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, like the title of the show. FA is in financialadvisor.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance. It seems like there's major headlines every week affecting investors, especially those in or near retirement. So join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201, College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, it seems like there's major headlines every week affecting investors, especially those in or near retirement. So Coasting in Retirement's co-host, Michelle, and I are going to help you all understand and decipher the deeper meaning of these headlines, particularly the ones that relate to our show topic today and have an impact on those in or near retirement. To remind you, our show topic, because we got some time here to fill, is New Year's intentions, not New Year's resolutions. Hey, Michelle, let's do this. But for the folks that are just joining us, what's your definition of New Year's intentions versus resolutions? Do I need to help you?
Sure, you can help me. I wrote it to you yesterday.
All right. So Michelle says, one, we decided resolutions are just not that effective. So
disappointments.
It just leads to disappointment. So intentions, this is Michelle Melton's definition. Intentions are courses of action versus resolutions that are more of a determination. Resolutions equal outcome. Intentions equals process. So this whole episode is going to be about financial planning process, the intentions that investors need to have as 2023 is upon us. So with all that said, and without further ado, here is Michelle with the news of the week.
All right, Josh, let's start with Smart Asset has an article titled, quote, 10 strategies to maximize Social Security benefits, unquote. So, I'm worried about Social Security and how I think it's going to be dire for me. But I learned a couple of things from this article. Firstly, I did not know you had to pay in it for 10 years. I didn't know there was a number affiliated with that.
35.
No, it read first eligible for benefits paid into Social Security
minimum
for 10 years.
There you go. Very good.
Right. So I didn't know that number.
Okay.
And then secondly, that Social Security is based on your highest 35 income earning years,
Right.
which seems like a lot of years. And does that mean I have to work 35 plus years to get Social Security?
Well, it sounds bad, but if you start in your mid-20s, you work to 60, there's the 35, right? And we're FTC regulated, I believe. Isn't that right, producer Mike? FTC regulated on the radio here. So I thought,
Yeah, sure.
I thought you would have a little fun with that smart asset. That is actually a very well-known financial tool and website that is used by a lot of financial advisors and clients, consumers as well. So, all right, let's get to answering your question. So, no, it doesn't mean that you actually have to have reportable income for a full 35 years. But the years that fall short, where maybe you didn't work, you're retired, or maybe not in the workforce, whatever it may be, there will be a zero for those years where you fall short. And that's the amount, that amount of your Social Security will be reduced. So sometimes working, what this means, here's what it means. Sometimes working for a couple more years past your desired retirement date might make a significant impact on your future Social Security. If you're at 33 years, you're at 58 years old, 60 years old. I know it sucks. It's easy for me to say here. I'm sitting here at almost 48 years old. That's a little bit in the horizon, if you will. But it could make a pretty significant difference on what your actual Social Security payout is. Now, for a lot of people, though, when they retire from their main career, they're done. As I hazard that Michelle will be done when she's done. And they have no desire to work anymore. So if you don't have the ability to stretch it out or maybe pick up a second job or a side hustle, just understand that when the calculation comes, there will be zeros if you're not at the full 35 years of working. Either way, whatever it may be, and Michelle said, minimum of 10 years, that is accurate. Either way, it's definitely a part of the conversation we're going to have at Gulf Coast Financial Advisors for those folks entering the retirement red zone, which typically is about 5 years or less before you are ready to retire. All right, great job, Smart Asset. Great job, Michelle. What's next?
Okay, back to a site you know well, Josh, and something you talked about in the opening. Your buddy Charles Schwab has an article titled Timing Matters, Understanding Sequence of Returns Risk. And I found this frightening. So I hope you're going to explain it to us and make it better. And I also know this issue comes back to math, but it's really a big deal for people entering into retirement.
All right, so we're going to, at first, absolutely, it is a huge deal. It is mathematically one of the most defining things that you're going to have for somebody that's entering in retirement. Again, I'll use 2008 as the example. We thought there for a while 2020 was going to be kind of a 2008, but it ended up being a V-shaped recovery. So let's do this. Let's rehash some of the things we said in the opening segment, starting with defining the sequence of return risk, because it sounds like a fancy term. It's not. It's just really a mathematical terminology that we use. So many folks, again, retiring, especially now, people are living longer. They're going to live for 20, 30, maybe even 40 plus years in retirement. During that amount of time, there's going to be a bear market. Historically, there's always a bear market over so many years. There's probably going to be more than one if you were in that retirement that long. So what it means is your finances will be much worse off if you slump at the outset of your retirement rather than the market downturn happening in the middle or the end. We like to, one way to give an example, it's kind of the mirror reflection. If you're somebody that started retire or saving for retirement early, then you enjoyed many years of compounding returns on that. That's great. The reverse can happen if you start taking money out in retirement in a bear market, and what happens is it decimates your principal and it permanently reduces the basis for enjoying the benefits of compound growth. Michelle, I'm gonna go ahead and use my math equation one more time. So we have two retirees. They start with $1 million in their portfolio. Investor A, Investor B, each of them takes a 5% withdrawal, so $50,000 per year for expenses. Investor A gets hit by a 15% market decline in his first year retirement. And what happens mathematically, he results in him running out of cash in that account by year 18. Investor B, however, is not hit by a 15% market decline until year 10 of his or her retirement. So they mathematically will still have about $400,000 left in their retirement account. Now I didn't say this in the opening, but that's probably with just a standard kind of rate of return for the stock market. There's no 10 years that are ever exactly the same. And honestly, we do some in our seminars, Michelle, where if somebody retired in 1990, that first 10 years, 1990 to 2000, was a great time to retire. If somebody retired in 2000 to 2010, not as great. So that actually can exacerbate this whole...
Exacerbates.
Thank you, Producer Mike. All right, so how do you mitigate this sequence of return risk? Well, number one, it takes a plan. If you have other investment buckets or asset classes that you can dip into instead of selling positions at a low point, that is what we're going to look at. At the end of the day, what you're really trying to do is minimize your principal withdrawal during a market downturn, especially early in retirement. These, once again, are parts of the conversation that we have with our clients at Gulf Coast Financial Advisors. All right, very good. What's next?
Okay, so have different buckets. Okay, so in
And
the
a
first in the first segment of the show, you discussed how rising interest rates might actually help with retirees trying to produce income in retirement. Well, that sounds good.
Mm-hmm.
Our last Coasting in Retirement episode discussed the use of annuities to produce income in retirement. So I think this article ties all of that together, I think. And it's from CNBC called Climbing Interest Rates Mean Good News for Annuity Buyers. I will say that I did learn something here too, that this was written in 2022, obviously, but the average...
towards the tail end, yes.
Yeah. And so the average payouts for immediate annuities, whatever that might be, it was increased 11% for males and 13% for females. Is that because we live longer, the girls?
Well, okay, so I'm going to jump around a little bit. The immediate annuities, what they should have said is immediate income annuities.
Oh, they didn't. It did not read
right.
that
So
up.
you remember this because you like the abbreviation SPIAs, single
Yes.
premium immediate annuity. So climbing interest rates, SPIAs typically are market rate adjusted. What that means is they try to be competitive. That means they raise the rates to have a higher payout. Consequently, you're seeing, I guess, probably across the industry, 11% increase in SPIAs. Deferred income annuities are a little bit further down the road. They move a little bit slower, but they probably too had some type of percentage increase given the rising interest rate environment. So let's go back to the article. CNBC either does a great job with their financial articles or they do a great job with their Google search SEO, because Michelle and I certainly find a lot of usable material on their site. So let's talk about the effects of rising interest rates on investors' common saving options. Most investors, everyday retail investors, have already seen the effect of rising interest rates that they've had on their fixed investments. It's a fancy way of saying like a bank CD. You go to the bank right now, you look at the rates that they're offering. More likely than not, unless they're a really, really poorly run bank, they are higher rates being offered now than there were 6 months ago, probably even 3 months ago, maybe even a month ago, don't know. But they're higher rates of return that they have. Those banks are trying to stay competitive. More specifically, many investors will utilize annuities, not all, but a lot of them will utilize annuities to produce income in retirement. As Michelle was mentioning, we have talked about annuities in the past. I'm not going to go deep dive into that again. If you want to learn more about annuities, go to our podcast, Coasting in Retirement. Go to episode 3, we break it down. But let's briefly talk about income annuities. Insurance companies do not directly base their annuity income payouts on the Fed funds rate. That's kind of a misnomer or miscommon perception. Fed funds is a short-term rate. Insurance companies tend to look longer term. But broadly speaking, bonds are a significant part of insurance companies' annuity products. Bonds are absolutely affected by the Fed fund rates and a bunch of other things. And that's what they use to determine the payout on their products. When interest rates rise, insurers get a higher yield on new bonds, not the old bonds, but the new bonds, which generally gets passed along to consumers in the form of larger monthly checks. So all this is a fancy way to say that rising interest rates can actually help those in retirement generate higher payments. A lot of it is, who knew? A lot of it is getting out there and seeing what is being offered in the market, what is competitive. All right.
Climbing interest rates in itself doesn't sound very
well for you
well.
For you and I, they're not retirement. As consumers, it sucks because we have higher mortgage rates,
Yes.
we have higher car loans, we have just higher credit card. It affects all of those things. Hopefully, in retirement, you've done a good job of buttoning that stuff up. If you haven't, it's not the end of the world. We can accommodate it. But if you have buttoned that stuff up, you're not worried about debt service as much. What you're worried about is what kind of income can you generate on someone else's debt service? Can you generate income on the debt service of the U.S. government? Can you generate income on the debt service of municipalities? Can you generate income on annuities? What can you generate income where rising interest rates are going to help you out? So very good. Great job, CNBC again. I'm sure for some listeners like CNBC, but we go there a lot. It's good. And next up, I think, is a site that you and I both have a good time with. What's up next?
Okay. That's correct. It is from Kiplinger,
All right.
which I think is the correct way to pronounce that.
Kiplinger. I like it.
But I might say it differently throughout. So you talked about investors taking real action to fight inflation in their portfolios, and I think Kiplinger expands on this with their recent article titled 5 Ways to Fight Inflation's Impact on Your Retirement Plan. Do you agree with Kiplinger? Do we have to keep on referring to Kiplinger? And also, is this also the same as that luggage company that makes the bright luggage?
Or is it the same thing as Kip Winger from the 80s
No,
band?
because
that's not the same?
This has less hair.
Oh, do we know it? Kip Winger, both right.
Linger.
Yeah, Kip Winger, great songs of the 80s. Would you agree?
I don't know if I would say great.
That would not either, actually. All right, so actually, this is one of the few articles on Kiplinger that I don't necessarily agree with fully.
Ew.
Yeah, so let me explain. The first thing Kiplinger says, here we go with that word again, says is to do an in-depth budget analysis. And again, remember, this is on your retirement plan. So in-depth budget analysis, there's nothing wrong with that. We happily do that when we need to. But the point of what they're trying to say is there's no doubt that inflation impacts retirees. We've been talking about that. But the reality of it, more often than not, that retirees, generally speaking, should be spending less on groceries, spending less on gas, spending less than what they did when they were running around in 20 different directions like Michelle and I do in our daily lives. So I don't know how much an impact trimming a line item in your budget is going to help unless it's a major line item. I mean, I guess you could eat out less, but that sucks. And as we've discussed on the show, people tend to live a certain lifestyle consistently even into retirement. Kiplinger also says to draw down on cash to fight inflation. No, we've already talked about that. When you're letting your cash go, you're basically, if you're using your cash now, you're using it when it has the least buying power, not the most. So let's keep that cash at work. Kiplinger also says to downsize and relocate. Again, fine with downsizing. I get it. Kids are out, you're retired, shrink the house, wonderful. But relocating, I know many retirees relocate, and I guess if you're moving from an expensive area of the United States to a cheaper area, that's fine. But moving and adjusting to a new area is expensive, and at the very least, it should not be done just to fight inflation. There needs to be other reasons with that, okay? So, again, the overall article's fine, but I think that there are definitely certain parts of it that I would push back a little bit on. So, which you don't hear much on this, but yeah, I definitely push back on that one just a little bit. All right, very good, Michelle. What do you got next?
Well, next up, so I'm going to say again, reiterate Happy New Year to everybody. And everybody is aware of how I feel about intentions versus resolutions. And I think we should take a look at the success rate of resolutions because I don't think it's all that great from my personal experience and probably across the board and across the globe.
I agree.
Okay, perfect. And I know the New York Post in the new year agrees because they just put on an article titled Why Most New Year's Resolutions Fail and a New Approach to Consider. For example, most people have the resolution to lose weight. Been there, done that. But they don't put the intention or the process in place to do so, i.e. think about what you're eating less, eating better, exercise more, and not just losing 40 pounds. So, what's your experience with New Year's resolutions?
Yes.
Josh.
Dismal.
At best?
At best. So, and here's why. I tend to be over-optimistic in the short run. I feel like it's one of my greatest strengths. I feel like it's one of my greatest weaknesses, all on two sides of that coin. I tend to hit my goals in the long run, but I think that particularly in the last couple of years that I have had my eyes opened, that I need to focus more on the process than the outcome. And sometimes when you set over-optimistic goals, the greatest strength of that is if you set something out there that is a big deal, it's really something that you want to go after, that even if you strive really hard to achieve that goal and you fall short, you've probably come further than you would have if you had never had that goal. The weakness with it is if all your goals are like that and they're all huge and you fall short on all of them, then you feel a little bit kind of beat up. You kind of beat up yourself. You have this inner dialogue of, well, I'm never going to hit these resolutions or these life changes or things like that. I think that focusing on the process, we like to use a lot of football references in here. We'll give Mike a little shout out. I think that Nick Saban at Alabama is really good at focusing on the process, not the outcome. Is that fair, Mike?
The shirt.
Well, that's what you got to do. All right, if you want the process, the goal, the end in mind, all right, which is what you're trying to do. All right, you got to have the process, man. All right. And that's what you guys are trying to do, create the process of creating value, all right, for yourself and your assets. All right?
Yeah, well, so Michelle and I decided we were not going to have guests on the show or call-ins, but I guess we'll make the exception for Coach Nick Saban. Thank you, Coach.
Thank you.
You're welcome, guys.
Yeah, well, obviously you want to rebut that real quick?
Or Eagle.
There you go.
All
right,
we'll talk about that.
So obviously focusing on the process that's one pretty strong example of how the outcomes tend to go in their favor. So yes, dismal on the resolutions, but I've made a change and off we go. All right, do we have time for one more?
I think so. So, all right, we've established that people should make New Year's intentions versus resolutions, but just to prove it's not our opinion and there is a deeper meaning behind the methodology, my final article is from not anything financial, but it's actually Psychology Today.
Very good.
Which we've got to use psychology to make these plans with you. So anyway, and it can, of course, be found under the motivation section.
Even better.
Yay! So the article is titled Better Than a Resolution. Try a New Year's intention. And I totally agree. And I feel like I'm so glad I'm backed up because I've been doing intentions versus resolutions for quite some time. So,
well,
do you agree? And I did like in this article too, and I think this is something that's good for everybody going forward. It read that each Monday should be a mini New Year's.
I like that.
I like that a lot too. I wrote it down, so that's gonna be that's my intention is to think
say that one more time. Every Monday should be a New Year.
Each Monday is a mini New Year's.
Is a mini New Year. So I can kind of like throw away whatever went wrong in the previous week.
Correct. And don't beat yourself up about it. It's in the past. Pshaw.
That's right. I think it's what our pastor says too, right?
That's great.
Tomorrow is done. Or what does he say? Yesterday is over. Tomorrow is a mystery, and focus on today, which is simple advice, but it works. All right. Well, as the listeners already heard, I absolutely I've been converted. I believe. I agree. It's probably the first and only time that we'll have Psychology Today in our Coasting Retirement show. But
I think you guys got it wrong. Yesterday is history. Tomorrow is a mystery, and all we have is the present moment. The process.
Yes, here we go. Coach Nick Saban coming in again. But yeah, so definitely I can say this. I made my intentions for the first time last year, 2022. And for the majority of them, they all appear to be on the right track or actually even where I have accomplished them. And that is quite a difference than some of the resolutions that I've had. So great find on the article, great motivation. Thank you, Psychology Today. And thank you, Nick Saban, for popping in there. So, all right. Michelle, great job with the headlines. These are all important pieces of information that impacts those in or near retirement. And for our listeners that are impacted by the news of the week, heck, even the Psychology Today stuff, are interested in learning more about what we do, we invite you to take action, start a conversation about your financial plan and all other parts of your life. You can reach us at 251-333-5151 or find us at gulfcoastfa.com. That's GULFCOAST, FA as in financial advisor.com. All right, folks, coming up after the break. Now, regular listeners are used to co-host Michelle and I getting to poke a little fun at me, typically. Yeah, me, not her. Sometimes I get picked on a little bit. And our segment is normally titled Where Josh Nailed It, where Josh was a little off. Now, in this segment, I typically get to share some opinions that I've made public that proved fairly accurate, and for balance, a few where I didn't quite stick the landing. But with the New Year's upon us, we're going to throw a little twist for this episode. So let me ask you, listeners, this. Ever made a New Year's resolution that you didn't keep? Maybe you didn't even keep it for a few weeks. I've already been honest. You can be honest with us. I sure have. So maybe even super planner Michelle has whiffed on a few, possibly. So what I want you all to do is tune in after the break to hear me and Michelle discuss times where our best intentions proved accurate, our best resolutions proved accurate, and well, maybe sometimes where we are a little human after all. See you after the break.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financialadvisors.com.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. So for regular listeners of the show, this is the segment where we typically get to discuss some of the opinions and thoughts that I've expressed publicly. We typically call it Where Josh Nailed It and Where Josh was a little off. But again, with the New Year's upon us, we're going to go along with the theme of the show, which for those of you all just coming in, the theme of the show is New Year's intentions, not resolutions. And we're going to mix it up a little bit for this episode. Michelle and I are going to share our past New Year's resolutions, maybe even some of our new Year's intentions. And we're going to talk about some of those that proved pretty accurate. And then to be fair and to go along with the normal segment, we're going to talk about the times that we swung and missed. I have a feeling it'll be mostly me talking about the times I swung and missed. But this will require us to be open and honest with you listeners. And in my case, I'll probably be a little raw because I'm a open, very emotional, personal person. And I tend to be a little open with some of my opinions. So this is going to involve Michelle's statements as mine. What I'll do is I'll start with one that I nailed this last year. So you ready, Michelle?
I'm ready.
Okay. So last year, January 2022, I promised myself that I would do everything I could to help me and the kids overcome a ridiculous personal situation by finding and buying a nice home in a great neighborhood, one that would allow them to meet new friends and have new experiences. So remember, folks, what I just said, what's a big deal? That's not that hard. For you listeners that are not familiar with Fairhope, Baldwin County, Lower Alabama, Eastern Shore, go on down the line. Finding a home for me and 3 kids in a nice neighborhood and yada, yada, yada in January of 2022 was a tall order. It was a red hot housing market, again, especially on our part of the Gulf Coast. And it was an experience. But again, this is where Michelle and I nailed it, where we were a little off. So in this, I nailed it. I was able to find the kids a great neighborhood down the road. It's a growing neighborhood. Some would say maybe growing too fast. It's got a great clubhouse. I hit the neighbor lottery when I moved next door to my neighbor, Brandon. I'll give a shout out to him. Unbelievable, great neighbor. He just happened to have a daughter that was the same age as my daughter. They became best friends. In fact, they're hanging out right now while we're in studio. And with that resolution, not only was I able to give my kids a great landing spot, it also allowed me to build a home that Michelle and I and all our friends and my family could enjoy, which is what I've experienced this past year. So with that resolution, I nailed it. It was touch and go when I made it. It's something that had to happen, but was it going to happen to the degree that it did? That was up in the air. Fortunately, I nailed it. So very good. Yay to me. All right, Michelle, you're next. What is something that you expressed either via a resolution or an intention in the past New Year's, and it had to be last year, you can dig deep, that either worked out or was a little off?
Okay. I am going to use last year's 2022.
Okay.
And it was an intention.
Okay.
And the intention was to find a new and better job with an easier commute. And that was my only intent. That wasn't my only intent, but that was my
That was your big one.
That was my big one because it's hefty and it was very significant. And I nailed period.
Capital letters.
Yay, me.
Yes. Yes, you did. Can I add context?
Yeah, sure.
Yeah. So we won't go specifically mention any towns or anything like that, but we can. If you don't mind me saying,
about an hour and a half commute each day,
right? And
20 to 10 each way.
Now, city planner in one of the fastest growing towns along not just along the Gulf Coast, but in the southeast in the country, Fairhope, Alabama, where we're recording right now. And you did nail it. Great leadership there.
Yes.
Yeah, great mayor.
Enjoying it. Yep.
Give a shout out to Sherry
Sullivan.
Yes. And what you found is just really kind of a family feeling to the employees you're working with.
Yes.
Yep.
And we have something to do with one of the fastest and best places to live in the United States.
Well, and there's a lot going on.
Yeah.
Right.
There is.
Yeah. You are not one. Listeners that don't know Michelle, you can probably get an idea from her voice and her energy. She's not one to sit still very well. Neither am I. But definitely in something where you're busy all the time. It's in a growing community. There's a lot of positive things going on. There's also things where you got to tackle and get your hands dirty and all that kind of stuff, right?
Yep.
All right. Very good. Well, you did great with that.
I agree.
Some would say
everybody we know agrees. So,
everybody agrees. Yeah. Some would say you manifested that.
I think that has to do with a lot of the process, the psychology part of it. Manifest it, think it, and it will come. Yes.
Yeah. Here in a minute, I'm going to give the definition.
And start making strides towards it.
All right.
Just dreaming.
So I'm up next. So again, listeners tuning in, this is the segment where we say where Josh nailed it, where Josh was a little off, because we're doing New Year's intentions, not resolutions. We're bouncing back and forth from Michelle and I, and we're talking about some of the things that we intended in the past, or maybe New Year's resolutions, intentions we made this year. So I mentioned in the beginning of the segment, I was going to get a little raw. So here it is. This is an area where I was a little off. And if my mom's listening, sorry, be talking about you, Mom. But for too many years, I had the resolution that I would help my mom and dad build their dream home, get it designed and built on some family land they owned back in Wapapello, Missouri, where I'm from. The land is called Punch Lake. It's, I'd say, roughly 8 to 10 acre lake that was part of the bend of an old river called the St. Francis that used to flow through out of the Ozarks into the flatlands. My family, my grandma and grandpa, bought the land many, many years ago. Gosh, I want to say back in the 50s, 60s. I could be wrong. Don't get mad at Esther. But they bought it. It was a family kind of place that we all gathered for many years. My grandma, grandpa passed away about 10 years ago. Through various time period, my dad ended up buying it, and that's where they intend to build a house and live. So for the past handful of years, I have been a little off on being able to help them, and it bothers me greatly. Let me explain. As you can tell, I come from a big, close, emotional, country, intertwined family. The generations of that family they can do, some families, the generations do their own thing relative to the next generation. My family, for better or worse, tends to think in legacy terms. We tend to all pull together. So when I say that I want to help my mom and dad build their dream house, it's not meant to be in a condescending way. They're more than able to do it on their own. They may not even need my help. It's just based on the fact that, one, the land means so much to us, to our family. It means so much to my mom and dad, particularly my dad. And it's really based on the fact that I wouldn't even have a financial planning practice down here along the Gulf Coast if it wasn't for their support. And when you do things to help each other, in my family, you do it for each other, and that's just how it is. So once again, in 2023, not a resolution, an intention is to help my mom and dad along their path of building their dream home on Punch Lake. So I think this year is going to be a little different. In some parts of my life, I'm not held back by an anchor. I am set free by a kite, if you will. And I will figure out how to help them along on that path. Again, not that they necessarily need me guiding them along, but I was a home builder in a previous life, built and or remodeled about 40 homes, so I do have some experience. And this is really one of my, as Michelle said in her part, there are little intentions, there's big intentions. This is definitely one of the big intentions. So on that, I was a little off, but I intend to change that this year. So, all right, Michelle, back to you. Do you have another one?
I have
one that you can say on air.
Yes, I have a resolution that a lot of people can identify with. Former resolutions I don't do anymore. And it's, still lose weight. You get older, gravity's a drag.
Yes.
Metabolism slows down. Ugh. So anyway, you just write down lose weight. Okay, what does that mean?
What does that mean?
How do you do
That's
it?
a resolution.
What makes you
I need an intention.
drink the extra beer or eat the extra cup of cake or what have you? So you got to focus on the mindset and the intention and the process. And now we know the psychology has something to do with it. And then when you look at it and you have the process, you might be working out more, which could help you lose weight. Maybe, but muscle weighs more than fat. So then with the process, you might just be getting healthier, even though you might maintain the same weight or even gain some in muscle. So just losing weight might not always be good.
If I had to guess, the vast majority of people want to lose weight.
Yeah. And that's why the gym's packed yesterday and the day before.
Yeah, and then by February, March.
No, by the end of this week, it's going to be, football's going to be back on, whatever. Yeah, no.
Well, so let's talk about that if you don't mind.
I think that article actually read by January 7th. It's like kersplat for most people. They're like, I can't do it.
I hear you. All right, so since this in theory right now, this is a financial planning radio show, I'm going to selfishly take that and turn it into something that talks about our practice, because I had this conversation with a potential client today.
Okay.
So when folks, everybody knows the ABCs of money, right? It's what your grandma told you. It's spend less than you make, put some away. Don't have an expensive lifestyle.
I thought that was a trick question. Like there was actually an A that started with an A and a P. I'm like,
what do you call that? Well, anyway, it's
always
not.
Pay cash.
Well, everybody knows the ABCs of money. You know the basics of money, just like everybody knows the ABCs of working out and getting healthy, right? So sometimes people will say, well, what good are you? When I already know how to do certain things with money, why do I need your assistance? And I put it.
I know how to spend money.
Well, right, but I put it to them this way.
That's easy.
Everybody knows how to work out. Everybody knows where the gym is. Planet Fitness, very affordable. Other gyms, you know what to eat. You don't eat fried foods like I do too much. Don't eat the ice cream that Michelle was referring to, so on and so forth. But what is the difference when you go into a gym, average person, and you just decide, I'm just going to get in shape, I'm just going to work out, and I'm going to eat better and all da-da-da-da-da. Well, sometimes it works out. Some people have the discipline and the know-how and all that. But often, if someone will bring a personal trainer along on that journey, the results that they will see are significantly greater than what they could achieve on their own. So what do I mean by that? You got somebody there that's going to hold you accountable, that's going to encourage you, maybe even admonish you sometimes, but you got somebody there that not only is going to be your guiding light or your guide, if you will, but also somebody that hopefully knows a few things about working out and or eating that maybe you don't, can keep you from getting hurt. Hey, don't do the bench press this way, do it this way. That'll save your shoulders, so on and so forth. So i.e., transposing that over to what I do, that's basically what we do, at least the financial advisors that do it like I do, is we are kind of a guide for somebody that's trying to get financially fit. Most people already know how to get financially fit, but if they have a guide that's there can show them, hey, don't do this because this will hurt. Try this because this will drop 5 pounds, whatever it may be. You get the metaphor. I think it's a metaphor. Yeah. When you're doing that as a guide, typically, generally speaking, you have a accountability partner that helps you get along further down the path than what you may have done on your own. So that is, I'm taking your losing weight and I'm totally turning it into a teaching lesson here.
I
so
like it.
You like it? All right, very good. All right, so Michelle, we have time for one more. Should we see what our producer, Mike Romano, has?
Let's see. Last year, I think you hit the nail on the head. Was getting in shape, and that lasted about a week.
That's normal.
This week, Kayla, I mean, I'm trying it again. I'm going at it again, and so like I said, so far so good. I'm starting out slow, just kind of. Because I think if you start out, you're right. If you start out trying to put too much on yourself, you're gonna burn out by week one.
You sore.
Well, here, Mike,
so I'm starting out just by doing the cardio, just the walking and getting kind of gaining the momentum that I'd like to gain before I go all hardcore.
Well, all right. So, Mike, I'm gonna put you on the spot. Mike Romano, producer. Right. We are recording in Archangel, which is Catholic radio. We're in downtown Fairhope. Mike is a very spiritual guy.
Yeah.
Yes. And one that I always look to, that, religious, spiritual, good man, so on and so forth.
Try to be.
Yeah. So on your resolutions in the past, have you ever done anything related to the spiritual? Or do you feel like you've already checked that box?
Yes, I have. And that was to read something, I think, spiritual each month. And so I did that, nailed that.
All right.
One thing I haven't done spiritual-wise, which I've just started doing, was I have a little app which is the Bible in a year. I think it's like YouVerse or something like that. Daily devotional app, right? And they've got a program of the Bible in 1 year, and that I have not done. I've done something spiritual like a little devotional each day, but that I'm sticking to it so far. I'm on, like I said, I'm on day 4. So
yeah,
I'm sticking to that. And what I like about it is it makes it into digestible, tidbits. Exactly.
Yeah, it's not overwhelming
right. Because I think it's so easy, to really just get overwhelmed, and you lose a couple of days, and you're like, what the heck? You lose a month, and you're like, I'm never going to get that back. Yeah, forget about it. Exactly.
All right. Well, very good. Well, I'm going to close then this segment with 2 things. One, Michelle, hoping on my speaking for us, but on the spiritual thing, one of our intentions last year was to.
That's actually. I'm glad you're bringing this up.
Start going to church.
That's right.
And we did.
Yes.
And we are. Yes, we didn't quit.
Josh actually went to church on Christmas.
I did, and we have an incredible pastor, and we always walk out of there just feeling so glad that we came. Yep.
Feel a lot better.
Yep, and definitely an intention. That is one where we nailed it. Mike nailed it. That's good advice. This is not a religious show, definitely, but those are things that absolutely will make you feel better about yourself. So, all right, so folks, we're going to close this part. We have one more segment coming up, the mailbag segment. Before we say that, though, we went through the top 7 financial intentions that retirees and pre-retirees should have for 2023. Again, we made the definition of the intention, which is process-driven, versus resolution, which is determination-driven. Thank you, Michelle, for that definition. And we did the first 4 because we didn't have time for all 7 of them. If y'all will tune in next week, we'll do the final 3 of those, and we'll probably throw in a bonus one. I did 7 because Michelle likes odd numbers for some reason.
I do like odd numbers.
Yeah, 3, 5, 7, so on and so forth, right? But
11, 13.
Depending on the time of the show, we have one more. So make sure you tune in next week to hear the remainder of this. Until then, have a great week. After the break, we are going to get into our mailbag of the week question. This has been Coasting in Retirement. See you after the break.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. Great show today, Michelle.
Yay, thank you.
All right, great job. Every week, we try to get to a listener's question if we have time. So we've got some time left today. Why don't we check in the mailbag and see if there's any questions needing answered?
Okay, we do have one, and it's from Nathan in Fairhope.
Hi, Nathan.
So, I'm an independent contractor with about 5 years left before I would like to retire. I've got a 401k from a previous employer and could contribute as much as I could to my traditional and Roth IRAs, but I'm concerned that it won't be enough. What options do I have to really go hard at my retirement savings as I prepare for retirement? All
right, so first, great question, Nathan. You're in what we call the retirement red zone, which we are football fans here. It's a football-based reference. I got to give credit to my good friend Jay Stubbs. And really what it means is you're approaching the goal line and you're hoping to score in retirement. It sounds like what you've been doing is fine, but now that you're seeing the end of your accumulation years coming soon, Nathan, you're probably concerned about the size of the bucket of money you're holding in your qualified investment accounts. So there's a couple of ways for self-employed or independent contractors or small business owners to run, again, a football reference here, a power play and get the proverbial touchdown football into the end zone. So these options definitely require conversations with a financial professional. So let's just touch on them in broad terms. There are solo 401k options that provide considerable more contribution limits than a traditional IRA or Roth IRA. And same with SEP IRAs. The limits are not exactly the same, but they're very close, and they're definitely significantly more than those other two options. There's also cash balance plans that sometimes make sense for small business owners that can provide significantly more tax-free contribution limits. You will need the help of a qualified actuary to implement that plan, but that plan or any of these other options we've listed, we can help. All you got to do is give us a call at 251-333-5151, or you can make an appointment on our website at gulfcoastfa.com. That's GULFCOAST, FA as in financialadvisor.com. So, folks, that's it for us this week at Coasting in Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton. Thank you.
You're welcome.
Yep. Thank you to our awesome radio station, 106.5 FM. Many thanks to the provider of our show music, local band Sloth Racer. And as always, a sincere appreciation for all of you out there that have been listening and joining us on this journey. Of course, we'd love to be a part of your journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.
Gulf Coast Financial Advisors has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are that you are on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Josh Knoll and the team at Gulf Coast Financial Advisors can show you strategies to help combat inflation so it doesn't outpace your retirement income. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Josh Knoll and the team at Gulf Coast Financial Advisors now to start inflation-proofing your retirement today. 251-333-5151. That's 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.